Good morning and welcome to Capital Sound. It is Friday, and the thing that jumped out overnight was the whipsaw in energy prices after the latest Middle East headlines, while the Fed stood pat even as inflation worries crept back into the conversation. That push and pull is exactly why today feels like a debate day. Is the market right to brace for more pressure? Or is this a transitory shock that fades by Monday's session? I am Mandy Prince, and with me is Bernard Gray, our resident value pioneer. Bernard, you and I are going to walk both sides of this.
Morning, Mandy. This is one of those mornings where price action could go either way, and the story is pulling people in opposite directions. From a value lens, what matters is whether these headlines change the long-term cash flows of the businesses or just the mood of the moment.
Exactly. Here's the debate. The Fed is steady, but the message sounded firmer. Traders are now pricing out rate cuts this year. Oil moved violently overnight, and global markets were rattled after the Fed meeting. So is today about pressure and protection, or about keeping perspective and looking for opportunity? We'll frame the bull case, the bear case. And then you'll tell us where you land. Sound good?
Sounds good. I'll try to keep it grounded in fundamentals.
Let's set the stage. We've got a central bank holding rate steady, but also saying it is ready to respond if inflation flares. We've got oil moving up and then easing in Asia, and we've got a lot of talk that this week's Fed meeting took rate cuts off the table. That is the issue. Why is the market split on this?
It is split because the inputs are mixed. On the one hand, higher energy prices can feed inflation, and that delays any easing. On the other hand, a policy stance that is steady can be read as confidence in the economy's underlying strength. So the debate is whether today's volatility represents a lasting shift in fundamentals or a short-term dislocation.
And the stakes?
If the higher for longer view hardens, that can compress valuations, especially for companies where future earnings carry most of the story. If it is temporary, then the focus returns to business quality, cash generation, and balance sheet resilience. It matters for which sectors lead today and which get hit.
Let's build the bull case first. If you are optimistic heading into today's session, what is your strongest argument?
The bull case is that the Fed's steadiness reinforces a baseline of economic stability. We're not looking at an abrupt tightening. We're looking at a central bank that is trying to cool things without derailing growth. That matters for businesses with consistent cash flows also. Some of the overnight oil volatility is being treated as headline risk rather than a new structural regime. If energy prices calm and supply fears ease, that removes a nearer-term pressure point. In that scenario, investors might be willing to keep paying up for durability.
So the market might shrug off the overnight scare.
It could, particularly if breadth stabilizes early and money moves into steady earners, utilities, staples, and selected healthcare. I also think banks could get a little lift on the margin if the Fed's message suggests higher short-term rates for longer, and that can support net interest income for some. Though not all. But there is a caveat here. Assuming rates don't spike, the constructive view holds. If rates suddenly jump, so does the pressure.
There is our first risk acknowledgement, and I am glad you said it. From a value standpoint, are there any opportunities today?
I'd frame it as areas where prices move more than business value. If quality companies have seen recent pressure because of macro fear, those are the ones that deserve a closer look. I'd also watch the banks closely because the Fed's proposal to ease capital requirements could be supportive for lending and capital return over time. Even if it is just a proposal right now, it might not move the tape today, but it can influence sentiment.
I want to pause on that. You are suggesting an upside case where the Fed's steadiness and possible regulatory easing create a floor, but the market's been rattled. Global stocks took a hit after the Fed meeting, and there is a lot of chatter about inflation fears. How does the bull case respond to that emotional layer?
It responds by reminding investors that markets often overreact to uncertainty. The key is whether earnings power changes. If energy shocks are temporary and demand stays intact, then a short-term correction doesn't change intrinsic value much. And when you view a stock as fractional ownership of a business, you are more interested in what the business can earn through a cycle than what the stock did overnight.
That is a strong principle. Let's make it tangible for listeners. What sectors might show strength if the bull case wins today?
Defensive and cash-rich sectors could be the surprise leaders. Utilities, consumer staples, and selected healthcare names can look attractive in a cautious tape. Financials might get a lift from the capital rule discussion, and I would watch quality industrials with pricing power. If inflation stays sticky, they can pass it through, but it is not a straight line. Some industrials are exposed to commodity costs.
All right, that is the optimistic side. Now, flip it. What is the bear case for today?
The bear case is that the market is underestimating how persistent the inflation pressures could be if energy remains volatile. You have a Fed that is signaling patience, and traders now see little chance of a rate cut this year. That can weigh on valuations because investors are paying less for future earnings. Combine that with global equity weakness overnight, and you could see a risk-off tone today. Another piece is sentiment. Markets don't like uncertainty, and the fog around energy infrastructures creates a premium for caution.
And the second order effects.
If higher energy costs stick, they filter into transportation, manufacturing, and eventually consumer spending. That is when you get margin pressure. Even steady businesses could see near-term earnings squeeze. In a tape like that, the market tends to punish cyclical sectors more aggressively, and you might see tech lag because longer duration cash flows are more sensitive to higher discount rates.
That sounds like a fairly defensive posture.
It is. The bear case is that the market is not fully pricing a prolonged period of tighter policy and higher input costs. Also, let's not ignore the policy overhang in the background. There is headline risk around the Fed chair transition talk. And even if it doesn't change fundamentals, it can raise volatility in the short run.
You've been careful not to get too political, which I appreciate, but I want to push you. If traders have already taken rate cuts off the table, isn't that already a bearish adjustment? Are we double counting the same risk?
That is fair. Some of the adjustment is likely already embedded in expectations, but the market can still react if data confirms that inflation isn't cooling. And today, the immediate driver could be emotion more than logic. If the open is soft, that can feed into a broader risk of mood.
You are suggesting the bear case might already be partially priced, but the tape could still wobble.
Exactly. And I'd add that I could be wrong if energy prices settle quickly and the Fed's messaging is interpreted as confidence rather than concern. That would take the sting out of the bear view.
That is the second risk acknowledgement, and I am keeping track.
It is important. Value investing isn't about certainty. It is about probabilities and margin of safety.
Let's move to our cross-examination segment. I am going to challenge both sides on the bull case. What would change your mind today and make you say the market is leaning bearish?
If we see broad weakness across defensives and cyclicals simultaneously, that would tell me it is not just sector rotation, it is de-risking. Also, if yields move decisively higher on the back of inflation fears, that can pressure everything. In that scenario, the bull case loses footing quickly.
And on the bear case, is it possible the market has become too pessimistic and is setting up for a relief bounce?
It is possible, especially if the overnight energy spike reverses and the early data flow is calm. Markets can get ahead of themselves. But the one thing that would challenge the bear case is a clear sign that energy disruptions are easing and inflation expectations remain contained. If that changes, so does the thesis.
You are threading the needle. I want your actual lean. Are you closer to the bull side or the bear side for today?
I am cautiously in the middle with a slight lean toward the bear case for the day's tape and a more constructive view over a longer horizon. The short-term risk is that uncertainty dominates and markets can be fragile after a jarring Fed week. From a value perspective, I am always looking for price and value gaps, but I am not assuming they'll resolve today.
So you are saying today could be choppy, but the bigger picture still favors quality businesses.
Precisely. For the day session, I'd watch for signs of stabilization. A defensive's bid. Is there selective buying in cash-rich firms, or is everything down together? That tells you which side is winning.
Let me put a finer point on it. If you are a listener preparing for the open, what should they watch in the first hour?
Watch how energy-sensitive names behave. If oil is calming, those sectors may recover from early pressure. Also, watch the banks. If there is any follow-through from the capital rule discussion, you might see relative strength. And keep an eye on market breadth. If it is uniformly negative, that is a caution sign.
That is a helpful checklist without telling people what to do. I also want to bring in the idea of valuations. You often talk about net-to-net thinking and margin of safety. How does that apply today?
It is a discipline. Even in volatile markets, we can ask, does the company have enough liquid assets and stable earnings to justify its current price? When prices drop on macro fear, that sometimes creates a margin of safety. But if the balance sheet is weak, the risk is amplified. The value lens isn't about timing today's move. It is about assessing whether a business can withstand a tougher environment.
That brings me to a challenge. You are emphasizing fundamentals, but the tape could be driven by sentiment today. Is that a mismatch?
It can be, and that is where patience matters. If the market is trading on fear, the value investor's edge is being willing to wait for clarity. I am not convinced that trying to predict every intraday move is productive. The focus is on avoiding permanent loss of capital, not capturing every swing.
I am going to summarize where we are, and you tell me if I've got it right. The optimistic side says the Fed is steady, energy fears might fade, and quality cash flow businesses could hold up. The cautious side says inflation and rate expectations are tightening financial conditions and broader risk-off could take over. Is that a fair framing?
That is fair. The nuance is that both can be true at different time frames. Short-term caution, long-term selectivity.
Now, let's push the debate a bit. Some listeners might say, we've seen these energy spikes before and markets snap back. Others say, this time the geopolitical stakes are higher. How do you weigh that?
I weigh it by looking at supply stability and whether companies have room to absorb higher costs. If energy volatility is short-lived, then history suggests markets normalize. But if disruptions persist, margins compress and earnings estimates come down, that is when valuations need to reset. It is not a guess. It is an observation about how costs flow through the economy.
You are very methodical, and I know some listeners like that, but I also want to ask, what is a practical, observable signal that the bull case is gaining traction today?
Look for a steady bid in defensives and selective strength in banks or high-quality industrials. Also, if the VIX is contained, say, around the low teens area, it suggests the market is nervous but not panicked. If those indicators show calm, then the bull case has a path.
That is specific without being overly technical, which I appreciate.
The key is not to confuse activity with information. Markets can be noisy. The important thing is whether the behavior is consistent with a lasting change in fundamentals.
Let's talk opportunities and risks for today, but we'll keep it responsible. What are the areas you think could surprise in either direction?
For surprises on the upside, I'd watch steady, cash-rich names in consumer staples and utilities, and some of the stronger banks. For downside risk, highly leveraged companies, and those with thin margins are more vulnerable if energy costs rise. And for tech, the risk is that higher rates pressure valuations, even if fundamentals are fine.
You mentioned banks twice, which is interesting. Is that the Fed's capital rule proposal in the background?
Yes, though it is still just a proposal. It signals a potentially looser constraint on capital, which could allow more lending and returns to shareholders. But if that changes, so does the thesis. We need to see how it evolves.
That is your third risk acknowledgement, and I appreciate that you've varied the phrasing.
It is important not to overstate conviction in a fast-moving environment.
Let's bring this home with a resolution. Bernard, what is your position, and how should listeners think about it as they approach the open?
My position is cautious short-term, constructive long-term. I expect the opening mood to be sensitive to energy headlines and the Fed narrative. For today, I'd be mindful of volatility and focus on observing which sectors show resilience for the longer horizon. The focus is on businesses with stable earnings, strong balance sheets, and a margin of safety.
And the key data points to watch?
Watch energy price stability, any new Fed commentary, and whether global markets stabilize into the US Open. Also keep an eye on breadth early in the session. Those signals can tell you which side of the debate is winning.
Before we close, I want to remind listeners that markets are closed this weekend, so you have time to digest this. There is no need to react to every headline. We'll see how this plays out when markets reopen Monday.
That is a good reminder. Let the dust settle and let the data do the talking.
Final thought from me, today's tension is real and reasonable people can land on different sides. That is why we framed it as a debate. If the market shrugs off energy and rate worries, defensives and cash flow businesses could hold the line. If inflation fears regain the spotlight, pressure could broaden quickly. We'll keep tracking it for the next session watch list on Monday.
And I'll add, don't confuse a rough day with a broken business. The value framework is built for days like this.
That is a smart note to end on. Bernard Gray, thanks for walking both sides.
Always a pleasure, Mandy.
That is it for Capital Sound. If you found this useful, share it with a friend who wants a clear-eyed morning setup. Enjoy the weekend, and we'll be back for Monday's session. End of script.